You ever look at the markets and just think, what is going on? Everything seems to be moving together, right? Stocks, crypto, even gold. It feels like they're all getting hit at the same time. It looks like total chaos. But what if I told you there's one single, powerful, kind of hidden force that's pulling all the strings? Well, that's exactly what we're going to unpack in this explainer.
And that powerful force, well, it's causing a lot of nervousness for investors. I mean, you can feel the instability everywhere you look. Which really brings us to the big question.
Yeah, this is the question on everyone's mind. Why is everything from stocks to crypto correcting all at once? I mean, why would the NASDAQ, Bitcoin, and even gold all hit a wall at the exact same time? It just doesn't seem to make sense unless there's a much bigger story playing out behind the scenes, something that's affecting all assets. And figuring out that story is absolutely crucial to understanding what's coming next.
So, the secret. The answer to that big question, it all comes down to two words: global liquidity. Now, I know it sounds a little intimidating, maybe a bit complex, but trust me, it is the single most important thing you need to grasp to understand your investments right now.
So what exactly is it? Okay, think of global liquidity as just all the money and credit that's, well, sloshing around the world's economy. The analogy here is perfect, really. If the global economy is a giant engine, liquidity is its fuel. Simple as that. When the fuel tank is full, that engine just roars. But when it starts to run low, yeah, it sputters, it struggles.
All right, so how does this actually work? How does more liquidity push prices up? It's a pretty simple chain reaction, actually. First, governments and central banks, they decide to inject money into the system. They might cut interest rates, take on debt. Basically, they turn on the money hose. That makes borrowing super cheap for everyone. Businesses, you, me. And what do we do when money is cheap? We spend it. We invest it. So suddenly you have all this new money chasing the same amount of stuff. The same stocks, the same houses, you name it. And when more money chases the same number of assets, boom, prices go up. That, my friends, is asset price inflation. And you know what? We don't have to look back in some dusty history book for an example. We just lived through the most insane, dramatic liquidity experiment in history, the response to the 2020 pandemic.
Okay, to really get a sense of the scale here, just look at the U.S. national debt. Back in early 2020, before everything went crazy, it was sitting at about $21 trillion. A huge number for sure. But then the crisis hit. And by 2025, it's projected to hit $37 trillion. I mean, just let that sink in. That jump is a massive, completely unprecedented injection of liquidity. We're talking trillions and trillions of new dollars, just fire-hosed into the global economy.
And the result? Well, it was exactly what you'd expect. It was immediate, it was predictable. Asset prices, inflation. With all that new cash flying around, asset prices just went to the moon. I mean, think about it. If you basically double the amount of money in the system, it's no shocker that the price of everything, from stocks to houses, goes way, way up. And here's a perfect example. Just look at the QQQ, which tracks big U.S. tech stocks. Before 2020, it's at about 176. After the liquidity flood, it rockets past 400. That's more than double. And look, that wasn't because all those companies suddenly got twice as good overnight. Nope, it was a direct result of way more money chasing the exact same number of shares.
There's a great quote from our source material that just nails the impact of this. It says, "It's like you deadlift 80 kilos and then one day suddenly try to lift 150. Your back will break." And that's exactly what happened. The economy was used to one thing, and then bam, it got hit with this insane shock. It was a jolt to the system. And frankly, we're still feeling the aftershocks today.
And here's another analogy that I think is just perfect. It's like eating 100 gulab jams in one day. For the next 2 months, you'll go on a sugar diet. That massive liquidity dump in 2020, that was the economic equivalent of a massive sugar binge. It felt great at the moment, right? But you can't live like that. So this period we're in now, with all the volatility and markets going sideways, yeah, that's the sugar diet. The world is trying to deal with the hangover without, completely crashing.
So that sugar diet idea, it perfectly captures what's freaking out the markets right now. The huge concern is that this little diet is turning into a full-on starvation plan, a liquidity squeeze. People are worried that the fuel for the global engine is about to be turned off completely.
Okay, and a huge part of this fear comes from something with a really complicated name, the yen carry trade. But don't worry about the name, the idea is super simple. For years and years, interest rates in Japan were basically zero. So what did big investors do? They borrowed tons of money in Japan for free, then turned around and invested it in places like the US or India where they could get a much better return. It was basically a giant free money glitch that fueled global markets. Well, that glitch is now being patched.
And this right here shows you exactly why the party's over. Japan has started raising its interest rates. It's not zero anymore. So that whole borrow for free trick, it's gone. That arbitrage is disappearing. And what that means is one of the biggest liquidity pipelines in the world is being shut off. And that is making the markets very, very nervous.
So, all of this, it leads to the billion-dollar question, right? The one on every single investor's mind. With this liquidity squeeze happening, are we about to see a massive crash?
To put it another way, are they draining the fuel tank so fast that this whole economic engine is just going to seize up and fall apart?
Okay, so while the fear is totally real, the argument is that a complete total collapse is, well, it's pretty unlikely. And the reason is simple. Governments can't afford it. They're basically addicted to liquidity. They need it to show economic growth. And in today's world, that's what keeps them in power. If they pull the plug completely, the economy grinds to a halt, and no politician wants to be in charge when that happens.
And you know what? The data actually backs this up. If you look at a chart of the global liquidity index over time, you see this really clear pattern of higher lows. So yeah, you get these scary dips, these corrections, 2018, 2020, 2022, but each time the market bottoms out, it's at a higher level than the last time. That pattern is super bullish. It tells you the long-term trend, the DNA of the system, is for more liquidity, not less. The whole thing is built to expand.
All right, we have covered a ton of ground here, from the basics of what liquidity even is, all the way to the yen carry trade. So let's boil this all down. What are the key things you absolutely need to take away from this?
Okay, here's the bottom line. Number one, liquidity is everything. It is the single biggest driver of asset prices. Forget everything else for a second. This is what matters most. Number two, all this panic in the markets right now, it's about a short-term fear of a liquidity squeeze. And number three, a total meltdown is unlikely simply because governments are hooked on liquidity to keep the economy growing. So what does that mean for you? It means, yeah, expect some short-term pain. We could see corrections, 8, maybe 15%, but the long-term trend, it's for more liquidity, not less. And that means asset prices will likely keep getting pushed higher by this unstoppable force.
And that leaves us with one final kind of unsettling question to chew on. We've established that liquidity is the fuel for growth, and governments basically can't turn off the tap. So, in a world that is completely built on a mountain of debt, is just creating more and more liquidity the only way forward? And if it is, what does that mean for the future? Something to think about.